So you cannot go wrong if you invest in Canadian banks. Some of them have been in business for more than 100 years. All of them have been paying dividends for decades, and only one of them has cut their dividend. Plus, they form an oligopoly protected by the federal government. How can you not invest in Canadian banks, right? In fact, you probably should have them all. Those are common things we hear about Canadian investors when they talk about their beloved banks. However, nothing could be further from the truth. In fact, since 2008, each bank decided to take a different route to grow their business. They have different strategies, and today they show a completely different business model and a completely different perspective. Some of them are amazing investment, while some others are not that great. So next week, I will come back with my quarterly review of all banks' earnings, as they have started to report their earnings already. But today, I want to give you a different perspective. I want to show you how to analyze those banks to determine which one should be in your portfolio. So we're going to talk about the business model, the important key metrics, the dividend triangle, and I'm going to do a deep dive on the revenue source so you are in a better position to understand what it means and how to determine if there's a potential here or not. Because believe me or not, there are some banks that you should not have in your portfolio. But I'm going to leave that to you. I'm just here to give you some information. So to look at the business model, what I decided to do is to go back into the annual report of 2023 for each of the big six. Why 2023? Because I wanted to have a full year perspective on their earnings and revenue mix. I know you're going to tell me it has been 9 months now since they have been published, but between you and me, a bank is a bank and their business model has not changed that much since last year. So that's why it's important to have a global overview instead of looking at one quarter where the earnings mix could be changed a little bit depending on what just happened. So let's get started with Scotiabank, the most international bank of the six. Quite of a nice strategy, right? We're going to benefit from our oligopoly model in Canada, use that as a strength to develop banking in Central America and South America, where in most of those countries, their GDP, their economic growth, will be a lot faster than Canada. Well, kind of makes sense, right? That is Sedictov story. And when you see their business model, well, it shows that a quarter of their earnings is actually generated outside of Canada. For the rest, we have a classic model with banking, with savings and loans for 41%. Then we have wealth management at 15%, and then global banking and markets. What exactly is this? We're going to talk about that later on in this video at 18%. So overall, 2/3 of their business is around classic banking activities, some wealth management, and some global banking and markets. Moving on to CIBC. CIBC has a more conventional business model. Most of their business, 63%, is classic Canadian banking for personal and commercial use. They kind of like put wealth management into that mix as well. I kind of don't really like this. I prefer to have it separate way because it has a different way to generate revenue than when you're doing mortgage and loans. We're going to talk about that later on in this video, but this is the way they decided to report their earnings. For the other 12%, we have it in the same business model, but in US. So we have a very classic business model here, and then 24% in capital markets and direct financial services, which is the equivalent to Scotiabank Global Markets. I kind of don't really like CIBC business model because since 2008, every single bank decided to take a different strategy, while CIBC kind of tried a little bit of everything. They went with wealth management, they went with expanding in the US, they also have some capital markets, but it's not exactly clear what they really want to do and their true identity. And you'll see in the numbers when we will compare each of them using the dividend triangle that it's not helping them to grow and outpace the other banks. Now we have a completely different business model with BMO, where 70% of their model is based on classic personal and commercial banking. 40% in Canada, 30% in the US. So well diversified. And in terms of like net income per country, we're really like at 55-45. So a good balance between Canada and the US. Then we have the other 30%, which is either wealth management at 12% and 18% for capital markets. Capital markets, for now, I'm just going to tell you that it is a highly profitable business segment, but also highly volatile. So if it's something that you like, well, you may like BMO because of its willingness to take additional risk. And most of the time, it pays off well. So they generate some earnings growth, which is quite interesting. But be aware that from time to time, they're going to run into a very bad quarter, shutting down their earnings for that period. TD has one of the most conventional business model where most of their business is built all around classic savings and loans. So personal banking and commercial banking, both in Canada and the US. This is the one with the largest exposure to the US market with 37%. We all know where it brings TD right now with the money laundering issue. So we're going to have to see what's going to happen on the US side. But for many years, it was quite a positive strategy where they were able to run on the economic growth of the US while benefiting from the oligopoly business model in Canada. We have another 14% from wealth management and then 5% that is wholesale banking. And once again, we have a new term. What is wholesale banking? Well, you have to go into the annual report, type in Control F for wholesale banking and going all the way down to that section where it explains you that it's pretty much capital markets. But again, sometimes when you're trying to compare apples to apple, more digging into those financial reports are necessary. Using the Control F in a 200 pages PDF is always super important. Now, Royal Bank maybe worked a little bit more in their annual statement where they put the numbers in dollars instead of in percentage. So I had to calculate those myself, which, okay, was not that complicated, but still, I could have appreciated just to have the numbers like in percentage as well. One thing that I really like about Royal Bank is the fact that they're super well diversified. So only 39% of their business is related to the personal and commercial banking, so the classic banking activities. Then you have 31% in wealth management, 20% in capital market, and then 10% in insurance. What is great about that is while it is one of the largest banks with TD in Canada, they are, of course, really well exposed to mortgages and the housing market. But if that part goes wrong, they still can count off 60% of their business to do something else because they're not linked to personal and commercial banking. And the last one, but definitely not the least, National Bank. I know, I get it. My favorite one. I've worked there for 13 years, but really when you're going to see its dividend triangle, you will understand why I like this one so much. So very similar to Royal Bank, it is a bank that is well diversified across personal and commercial banking with 42%, but then wealth management at 23%, financial markets at 24%, and then 11% for US specialty finance and international. That segment is actually just two companies, so ABA Bank in Cambodia for the international portion and Credigy in the US for the US segment. Doesn't mean that they're not going to make more deals like this, but in the meantime, what they are working on right now is the acquisition of Canadian Western Bank, which was covered not too long ago on my podcast. So as you can see, each bank starts with a good foundation about personal and commercial banking, but then they all go somewhere else. Some with capital markets, some others with wealth management, some others with South America, others in the US. But each of the bank has a small plus or a small minus that will help you decide which one you want in your portfolio. And before you tell me, oh, I want all of them because it's going to be great. Well, if you want all of them, let me bring you back to this cooking analogy. So you're making a soup, right? So you put all your favorite ingredients and that's all good. It tastes good. And then you're just like, yeah, I'm going to add some salt, right? Because well, we all know this. When you're cooking, if you add a little bit of salt, it's going to get the flavors a little bit better and it's just going to taste better. So you go with table salt. And then just like, oh, but I remember that I have like pink salt and Hawaiian salt. And I also have like some black salt that I took back from Iceland. And then you're putting all of those kinds of different salt, even lava salt. That's the thing. And then in the end, you have like 6, 7 different types of salt in your soup. Is your soup's going to taste better? No. Like it's not better diversified in terms of taste. You're not like increasing the flavor. You're just increasing the amount of salt. So either you have a bunch of Canadian banks with all small holdings that they will not really have a different impact, but they will all together be exposed to the same thing. But that means also that every quarter you have to monitor each of them because as you saw, they're not the same. Or you have a huge part, like 3-4% in each of those banks, and now your portfolio is greatly exposed to all the financial market problems that could happen in Canada, such as a housing bubble, a credit crunch, and so on. Is this really what you want in your portfolio? Because believe me, sometimes it's not that great to be a bank. When I do those quarterly reviews that I will do like next week, the key metrics I look at is mostly the earnings, the provision for credit losses, and the dividend metrics. Why? Well, first, for the revenue, it's going to give you a pretty good idea for their business model, but really, a bank is about money, and money is about making profit. And making profit, well, there's nothing better than earnings per share, right? So the earnings per share and the trend is probably the most important metric that you want to look at when you analyze a Canadian bank. The second one is the provision for credit losses. Why? Well, as you saw in the business model, most of them have more than 40% of their revenue and earnings coming from banking. And most of the banking system will be affected by the provision for credit losses, where banks believe that they will not get that money back and eventually will have to do a write-off. So it's kind of like the last step before being a full write-off is just those loans are late. I don't think I'm going to get that money. So I might as well put that as a provision for credit losses and reduce my earnings accordingly. And over the past 2 years, we've seen those going up a little bit too high to my taste, right? So when there's an increase of provision for credit losses from one quarter to another, from 1 year to another, it gives you a sign that the economy is slowing down, that maybe we are going to get into a recession, and the consumer have a problem paying down their debt. So for a business that is increasing those PCLs, it just tells you it's not going to look good for the upcoming quarters. Now, interestingly, the higher the PCLs, the lower the earnings, so they will work together. So sometimes it's also important when you have like a very good quarters with earnings that are super high. Maybe the company just reviewed their PCLs from last year and they got less losses, therefore the highest earnings, but it's not real earnings because it was just not real losses in the first place. So you just have to be careful on where the earnings growth is coming from and to dig a little bit deeper into the quarterly presentation just to understand if the bank is really making more money or if it's just simply an accounting game. The last, but certainly not the least, the dividend metrics are super important for banks. Why? Because they are known to distribute a good part of their earnings. Typically, they will show a payout ratio around 50%. So for the banks that shows a payout ratio above 50 and most likely above 60, then you can start wanting to dig a little bit more because maybe there will be a problem with the dividend growth down the road. And we can see what's happening this year with Scotiabank. It shows the highest payout ratio, and guess what? No dividend growth this year. So no dividend growth means a dividend cut for you guys because you know what? The grocery bills keeps on increasing even if your dividend did not increase this year. So you're losing buying power if you owed Scotiabank. You kind of have to take note of that, right? And on the other side of the spectrum, you will have companies with a payout ratio under 50%. Most of the time, those are the ones who will show a stronger dividend triangle and also a stronger dividend growth profile. So overall, look at the earnings, look at the PCLs, look at the dividend growth and the payout ratio, and you're already going to have a pretty good understanding of what is going on with Canadian banks. So before I explain how business units are making money and what it involves for Canadian banks, I would like to invite you to download the Dividend Income for Life guide. This guide will show you how you can actually build a portfolio with a good yield, a good dividend growth, and of course, not too much salt in your portfolio. You can download it for free by just simply entering your email, and I will be able to send you the guide. So the link is dividendstocksrock.com/income. So dividendstocksrock.com/income to get the Dividend Income for Life, where you will see more about my investing philosophy and how you can identify those amazing companies with great dividend triangle. All right, now, so to have a better understanding of the business model and to be able to write down a great investment thesis, you must understand how divisions are making money within a bank. So the first one is pretty obvious: personal and commercial banking. They are making loans, they are getting the interest, they're making money out of it. So long story short, this is pretty much how it works. The name of the game here is the underwriting process, to be able to give the right loan at the right price to the right client to get paid back. So that's pretty much the game. This is not necessarily where there's going to be a big difference between any of those banks, but rather when you go into the other business. So first, exposure outside Canada. As you saw earlier, most of them has decided to get exposure either to the US or to other countries. It has pluses and minuses. So in the US, it's great, but on the US side, there are like thousands of banks, and it's kind of a little bit of a Far West over there. We saw that from time to time. We kind of have like banking crisis. The way that they manage their balance sheet is a bit different, and sometimes they get into real big troubles. We saw recently that most of the Canadian banks that have a strong exposure to the US has also some other problems with their provision for credit losses. So you have to be careful. While I love National Bank, its exposure to Cambodia and specialty credit in the US is also a source of concern. Right now, it's going perfectly fine, but you never know when it's going to slow down. As for the international exposure, well, we saw it turns out to Scotiabank. It is just a source of concern, and it creates more volatility than anything else. But one thing is for sure, it does not help them to make more profit than other banks. Then you have the insurance segment, which is usually pretty small for each bank, and it's all about writing the premiums. Similar than the banking industry is to just do the right underwriting for the right client with the right price. It is an interesting business model, but it's not a significant portion of their earnings. So usually it's not going to turn the quarter good or bad if this segment has a good performance. One segment that I really love, and I think there's a lot of future growth that will be coming from, is wealth management. Well, wealth management, kind of easy. A lot of people need to have that kind of support. And I'm not just talking about those like cheap like they're expensive actually, mutual funds with bad advisors that you're going to get in the branch, but rather like private banking, private wealth management with upper level investment services and also upper level advice, estate planning, financial planning, and all that stuff. I'm not saying they're all great in that, but there's a lot of futures because there's a lot of future growth because the demand is there. Another sign that there's a lot of demand, well, all the life insurance companies such as Great-West Life, Manulife, and Sun Life has all a major wealth management department now. So everybody wants to make money out of their clients by managing their investment. And I can understand why, because once you sign a client, you're making a recurring revenue every single year on charging a fee on their assets under management. So I kind of like that recurring business model. It is a little bit more stable than the other types of businesses, and it's completely different than what's happening with the credit side of the balance sheet. And finally, there is the more complicated division, which is sometimes called capital markets, sometimes called financial markets, sometimes called global banking, or even for TD, wholesale banking. It's pretty much the same thing. It's divided into two categories. Most of the time, banks will offer those two categories. The first one is global market. Global market, it's really about the investment business. So we're talking about market making. So the difference between the underlying ETF and the ETF. So for example, we're going to take like an ETF that tracks the big six bank. So you have the ETF on the side, and on the other, you have the counterpart, which are the six banks. So banks will ensure the liquidity. They will ensure that all parties can buy and sell stocks, buy and sell ETF, and making sure that everything on the stock market runs smoothly. Another side of that global market is product development. You know, those link nodes, some other specialized ETF with other type of strategies. This is the department that will be able to do that, and they will also do research. So they can sell that research, sell that data to other investment firms. So overall, it's all about the stock market by making sure the stock market is liquid, making sure that they develop new products, and that they sell their research. The other side is corporate and investment banking. So then we have like special project financing for large companies that they want to have like a special project. They will go through bank, but it's not going to be considered as commercial banking, but rather corporate and investment banking. There's a lot of work involved also into mergers and acquisitions. So they can work as advisory, they can finance a deal, they can help negotiation as well. So that is also a big chunk of investment banking. And finally, you have debt and equity underwriting. So a company that wants to go IPO and or issue more shares or get into a bond issues, well, they will have to go see a bank. So that is also related to this segment. As you can see, it can be very profitable when there's a lot of needs, but it could go sideways big time, especially in the market making, the product development, debt and equity underwriting. You never know how it's going to turn out, the mergers and acquisition as well. So that has a lot of uncertainties, but of course a lot of growth potential. So now that you know each bank's business model and the how business units are working, you are in a better position to determine which one you want in your portfolio. Do you want a bank that is classic savings and loans, or have a huge exposure to the US, or a more diversified banks, or another one that is more about the stock market and investments? Now you get to pick the different one and kind of like tailored your portfolio a little bit more about your taste. At this point, sometimes it's good, sometimes it's bad. The most important part is that you understand what you own in your portfolio and why you own it. Hey, Peter Lynch. And for the last part, we're going to use the DSR stock comparison tool, because you're probably going to tell me, oh, but Mike, I want them all anyway, because I don't mind about like the differences and I just want to invest in all banks. So I want to show you what the real numbers will tell you about each of them by looking at the dividend triangle. So let's take a look. All right, so we are on Dividend Stocks Rock. I'm going to show you the stock comparison tool. We have used that a few times on the on this channel, and this time, instead of like keying all the stocks one by one, we can actually load an entire industry. So we're going to load a pre-selection. And in this case, of course, we are in the Canadian market, even though we track both Canadian and US market. We already know that we want to go into the financial sector. So we're going to go here and select financials. And of course, we don't want to have the life insurance companies and other like asset managers, for example. So we are going to go into the industry and we are going to select banks diversified. So we're just going to pull out the 6 Canadian banks like this. So you can see we have 6 stocks. If I move my screen from the right to the left, I'll have BNS and CIBC that are right there. But I just want to hide them for now because they're not my favorite. All right, so going here, we have the overview, but I just want, since the video has been taking a long time already, I just want to show you what the dividend triangles different look like. So here we have the dividend triangle right here. So we have the revenue, the earnings per share, and the dividend growth. Of course, we have some of them that are negative, such as BMO, TD, and if we look over here, we have Scotiabank and CIBC The reason why they're negative is they have reported some one-time event. So for BMO was the acquisition of Bank of the West last year. For TD, they have a lot of things going on. So they decided not to go ahead with the First Horizon acquisition. They are right now under investigation for the money laundering problems. For Scotiabank and CIBC, they had also higher provision for credit losses. So we do have some earnings slides here, but for Royal Bank and National Bank, we did not have that problem where it is still in positive. Of course, it's going to change from one quarter to another, from 1 year to another. So the 5 years will give you a little bit of the story, but we're going to take a look at the dividend triangle at the end just to see the difference between one of my favorite and one of the worst. So of course, you'll have also the dividend growth over the past 5 years. So 9% for BMO, 10% for National Bank, 7% for Royal, and then we have 8% for TD. And unfortunately, we have like 5% and 5% for Scotiabank and CIBC. We already know that Scotiabank is going to continue to decline because this year it's going to be a big fat zero. And of course, I want to show you the dividend triangle for Scotiabank. Why? Because I want to explain you that numbers are great, but the trend is even more important. As you can see here, since 2020, the revenue growth is not that impressive. So the company is relatively stable, but not able to show growth here. For the earnings per share, it's pretty much the same problem. Actually, it's actually going down right now that we have higher provision for credit losses. So we're not even at the level of 2019, 2020 before the pandemic. Of course, we're not going to look right here. The pandemic being a one-time event, chances are we're going to run into another pandemic while we live are pretty slim. And you know what? I'd rather be on the positive side instead of looking at the worst case scenario. For the dividend, well, here again, it was the regulators saying you're not allowed to increase the dividend. But as you can see, after this period, it's not going that fast. And now it's a big flat $1.06 per quarter. And it's going to be the case for the rest of 2024. So in 23, a small increase of 3%. In 24, a no increase. So that kind of explained why the stock price went from like $90 right there to all the way down to $65. I kind of like understand what's going on here. Now, let's go back right there and look at National Bank to see the difference into the dividend triangle. So the numbers were speaking by themselves, but really, if we go back here and we look at the triangle, see how the revenue keeps on going up all the time, the earnings per share are actually going up as opposed, keep in mind, that is the other one. Scotiabank is down here and National Bank, of course, struggling a little bit. That is being explained because of the economic environment that we are, but still pretty solid. And the dividend growth right there, my friend, keeps on going up all the time. As opposed to Scotiabank, once again, that is pretty much flat. I mean, when I look at those numbers and when I look at the investment thesis, it seems pretty obvious which one I want in my portfolio and which one I would run away from and sell all of those right away. I'm not telling you what to do, but you can tell that those two companies do not have the same financial metrics. They do not have the same business mix and certainly do not have the same investment thesis. And that are the key component to analyze a great company versus a not so great in the same industry. Super important, once again, to understand the business model, to be able to explain it to a 12-year-old and understand where are the risks and where are the pros. Again, I hope that you have enjoyed this video. Don't forget to give me a thumbs up and subscribe to the channel to not miss my next week earnings review for all the banks. It's going to be a lot of fun. And until the next video, don't forget to stay invested.